Do we get a recession this year? From where you sit, what are your thoughts?
Thanks so much for having me today. That is obviously the question that's top of mind for many of our CEOs and many of the corporations that we speak to. Our economists, as you've noted this morning, have increased their odds of a recession this year, but really more focused into next year. And so that's what we're watching really carefully right now to see how the data plays out, how the economy persists, and where we end up. But the good news is that the financing markets are very open right now. And so we're helping clients who need funding make sure that they get the capital they need to operate their businesses.
It's funny because on one hand, you do have high yield bonds really falling off for the year, really reaching levels you haven't seen since late 2020. But you have your CEO a few weeks ago, really in May, telling me that even though the process has been orderly, it hasn't really spilled over into credit spreads. It would be something more concerning if it did. Beth, I'm wondering from your perspective, what is the level you're looking out for in terms of absolute yields or in terms of turmoil that you can get in high yield markets that would really start to scare you?
Well, the markets definitely have been volatile this year. We've seen a pretty significant move starting in rates. We've sold off anywhere from 175 to 200 basis points in rates. And you're right, Sonali, credit has definitely moved wider. In the IG space, it's about 60 basis points. When we look at high yield, a little more than 100 basis points. And so we are trending towards the wides that we've seen in the recent past. We're not making all-time wides. We're certainly not looking at sort of the stress moments of 2020 or 2008, but we are watching it carefully to see where things are, where things are breaking down. For the most part, I'd say investment grade markets remain very strong, and high yield has been a little bit more cautious. There's plenty of capital out there in investors' hands that needs to get put to work, and so it's just a matter of them having the moments where they feel excited about re-engaging in the markets.
Beth, when you look at kind of those riskier borrowers here, how much are you worried about their ability to kind of make it through the downturn that we are seeing ahead of us? And how much do you worry that, in light of what happened in 2020, the money might not be there for them this time around?
Well, the good news is that many of the corporations took the advantage of very low rates and tight spreads over the past several years to do a lot of refinancing. And so what we've seen is that balance sheets are actually quite strong going into this moment, going into this period of higher inflation. And for companies who really needed to, they've done some good work in making sure that they are in a position where they can, continue to focus on growth, or if need be, look at, maybe pausing some of the growth plans to potentially restructure their balance sheet and make sure they've got the capital they need to weather what might be a bit of a storm ahead.
Beth, I'm also trying to get my mind around sort of where the leverage then is going to be. So if companies may be levered, but they have low interest rates, they locked it in, their balance sheets are not that bad, they're actually pretty good. That's not like an '08 kind of scenario. When you take a look at the landscape, where is that leverage going to come from that's really going to get squeezed?
Well, I think you're absolutely right. We're not looking at an '08 kind of scenario. I think when we step back and try to look at parallels for this market environment, the closest thing that I come to in my mind is something more like a 1994. I know there aren't a lot of people in the market who lived through that moment. I unfortunately are one of them. But look, it's the last time that we were in a sort of modest recessionary environment. And I think that's what hopefully this is setting up to be. Obviously, time will tell. We need to watch the data more carefully to see if inflation is going to be tempered. The Fed obviously upped their game pretty significantly with the 75 basis point hike last week. And so they're really taking the fear, the problems that inflation can bring quite seriously in this moment.
We haven't even seen the most of what we can see from quantitative tightening as well, Beth. And we're already hearing so many market participants talk about lighter liquidity in the market. So to what extent is that a concern for you, and how do you expect things to play out?
We definitely see investors with a lot of cash still to put to work. And so I know there's concerns, there's worries about where are those next buyers going to come in from where we sit in our conversations with investors. Right now, they're moving into cash as a more defensive move. It's not that they don't want to re-engage in the markets. It's not that they won't be putting that capital to work, but we've had such a significant move so quickly that they want to take a moment and reassess what the outlook is from here, so they can make sure that they're stepping in at the right moment for their shareholders, their investors.
I want to pick your brain as also someone who is deeply entangled into the workings of the Treasury as the chair of the Treasury Borrowing Advisory Committee. How do you think about the volatility in the Treasury market and how that might impact markets moving forward?
So it's definitely been a very significant move, and it's one that we've spent some time in the borrowing committee talking about, and obviously policymakers are spending a lot of time looking at that. anytime you have such a fundamental shift in the macro environment as we've had at the beginning of this year, you're expected to see some amount of volatility. And so we did a presentation at our May meeting, our last meeting, where we really looked at what those moves have been. And when you vol adjust it for the overall sea change and the rapid environment shift that we're seeing, is the liquidity shifts, is the top of order book, the bid-ask spread widening, is that more than you would anticipate given the increase in volatility? And really, when you step back, it's not. Now, obviously, there are some signs that we need to be watching very carefully to see how things progress from here. But at this point, I would say the markets have been pretty orderly for the size of moves and the seismic shift, really, that we've seen year to date.
So, Beth, why do I keep reading so much about liquidity gaps?
I think that the environment we've lived in for the past 10 to 12 years has been just a real abundance of liquidity. And I think when we go back and look from a historical perspective, that this past 10 years post-financial crisis is going to be the anomaly, not the space we're living in right now. But of course, we all have very short memories, markets in particular. And so we expect the liquidity to be what we've seen over the recent past. And I think given the type of moves that we're seeing now, the 10 to 15 basis point moves per day rather than the 2 to 4 basis point moves per day, that depth of order book that we'd experienced in the past couple of years when you're in a calm market is just really not possible. And we really shouldn't expect that going forward.
Beth, we're also getting a question from a viewer who was asking about what you were saying about 1994. In 1994, we weren't waiting for China to come out of COVID zero. And what does that play into your inflation call as it pertains to the U.S. as well?
It's definitely something to watch. And I think one of the things I would expect as the Fed drills in a bit more into this inflation story that we'll start hearing about is demand side inflation versus supply side inflation. And the COVID zero policy that we get from China is really causing a supply side inflation, which the Fed, with the many tools that they have, really can't do that much about. And so I think what we'll be looking for is, as we look at these inflation numbers coming out over the next several months, as we're watching and unpacking them, how much is really coming from the supply side and how much is coming from the demand side. And I think the Fed wants to get to a place where they can use their tools to help slow the demand side inflationary pressures that we've seen. But I think they recognize their tools are going to be a little bit more limited, and we need some of the global policies, whether it's the war in the Russia-Ukraine to calm down or COVID zero in China, to really help mitigate some of those supply side pressures we're feeling.
That this big slowdown we've seen in issuance, whether it's in the debt markets or it's in the equity markets, how much of an impact is that going to have on the Wall Street banks at large?
Well, we're going to get into the end of quarter in the next week or so, and then obviously we'll be into earnings season, and so the banks will be reporting. I think what you've heard from most of the financials conferences to date is that the equity markets and equity revenues have been down because of that. The IPO market obviously has been much more challenged given the fact that the volatility we've seen has made it a bit more difficult. But companies are getting creative. And so we've seen companies coming into the debt markets. Investment grade, as we've talked about, has been very robust. The high yield market remains reasonably strong. And as it relates to the equity markets, we've seen a good number of secondaries, some block trading, and some private markets have stayed pretty vibrant. Derivative activity remains very high. And so I think there's a lot of optimism out there still.